This is ShadowQuant, Stocks, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Thursday, August 13, 2026, and this is the New York pre-market. Now, let's get into it. The S&P 500 is hovering at $77.49, but don't let the COM index readings fool you. We are witnessing a violent structural split in the American market. Technology is surging while consumer discretionary is getting crushed, even after reporting profits. It is a tale of two markets, and right now, the gap between them is widening fast. Let's look at what's driving this divergence. Turning to the calendar, we have a dense block of earnings coming online today that will test this fragile equilibrium. First up, Apple is set to report fourth quarter figures with an estimated earnings per share of 81 cents. Simultaneously, we're seeing a flurry of smaller cap reports including ABO, ECHV, ACOG, ACIN, ACTU, AGT, and E, all scheduled for release today. Additionally, eBuy is in the mix with an estimate of 13 cents. These prints will provide the first real stress test for corporate earnings power in an environment where GDP growth is sitting at just 1.5%.
On Apple specifically, the question isn't just whether they beat estimates, but whether the market believes their growth trajectory can withstand the current macro stagnation. Given that broad market volume is stable but internally fragmented, Apple serves as the litmus test for whether institutional capital still trusts large-cap tech as the primary safe haven.
Let's start with the most dramatic movement on the board today. Tapestry, the luxury goods retailer. It has gapped down 14.2% to $131.88, completely ignoring its own earnings beat.
This is the textbook definition of valuation compression. Tapestry reported a solid quarter, yet the market is punishing the stock because the beat and raise narrative no longer commands a premium in a cooling labor market. We saw unemployment hit 4.1% and non-farm payrolls contract by 23,000 month-over-month. Consumers are pulling back. Tapestry's drop signals that investors are no longer willing to pay up for brand loyalty when the underlying macro data shows shrinking disposable income.
And that brings us to the sentiment paradox. Look at the VIX. It's sitting at 15.28. On paper, the market is calm. But on the ground, Tapestry has lost 14% of its value in pre-market hours. That is not calm. That is suppressed panic. The low VIX is lying to us. It suggests complacency, but the magnitude of Tapestry's sell-off shows that fear is actually concentrated in specific, high-vulnerability sectors rather than spread broadly.
Exactly. And here is the danger. When the VIX is this low, traders assume there is no tail risk. But Tapestry's crash proves the tail risk exists. It's just hidden inside single-name exposures. If you are holding consumer discretionary baskets expecting a smooth ride based on that low VIX reading, you are walking into a minefield. The disconnect between index-level calm and sector-level violence is where accounts get blown.
While Tapestry collapses, let's contrast that with YETI. They also beat profit estimates and raised their full-year outlook, yet they are down 7.5% to $47. CIPHER, why is the market rejecting these positive fundamentals?
It's about the ceiling. When GDP is growing at only 1.5% annually, companies like Tapestry and YETI can't justify perpetual multiple expansion. They've already priced in the best-case scenario. Once you raise guidance but don't explode upward, the easy money exits. We are seeing a rotation away from consumption-dependent businesses toward infrastructure and efficiency. Compare this to Hewlett-Packard, which is up 6.9% to $31.30, or Dell, up 3.9% to $503.59. Those rallies are driven by Lenovo's strong quarterly growth, a tangible, external catalyst validating the thesis. Tapestry and YETI had no external spark. They relied purely on internal beats, and the market said no.
I'd add that this is killing the consumer discretionary trade psychologically. When you punish two different brands, one luxury, One outdoor lifestyle. For simply doing a good job, it tells every fund manager in New York that the consumer is broken. That sentiment bleed doesn't stay contained in TPR and YETI. It spreads to the entire consumer discretionary sector, which is down 1.13% today. So we have a sector-wide retreat in consumer discretionary. Now, look at the bright side. RS is surging 17.7% to $502.69, setting a new one-year high. Grid, walk us through the technical structure here. How did we get a breakout of this magnitude while the rest of the market is flat?
RS is exhibiting pure momentum isolation. While the SPY is fighting to hold its support at $77.28, the low from August 12th, RS has completely detached. It gapped up and closed firmly above the $500 psychological level. Technically, this confirms a breakout from its consolidation phase. The key now is whether it can hold that $500 mark as support in a two-speed market. RS is acting as the speedboat while the SPY is dragging anchor. The volume profile supports this move. It's not a dead cat bounce. It's a confirmed structural shift in buyer dominance.
She's right, but I'll go further. Look at the microcap volume anomalies we're seeing. Boxel is up 168% with massive volume spikes, and LSPR is up 132%. This is late-cycle speculative froth. When you see RS running at a one-year high while Boxel and LSPR are exploding due to speculative volume, it tells me we are in a pick-and-shovel environment where money is fleeing broad indices for specific, volatile narratives. RS is the safe version of that risk, which makes it dangerous because it attracts institutional money that usually avoids the junk like Boxel. Once that institutional money rotates back to cash, RS falls fastest.
That's a stark warning on concentration risk. Let's zoom out to the broader market leader, the technology sector, the Technology Select Sector SPDR Fund. It's up 1.49% to $188.86, significantly outpacing the triple Q, which is up only 0.73%. Grid, how does the technology sector compare to the triple Q technically?
The technology sector is leading the charge, but triple Q is catching up slowly. Triple Q is at $723.70, trying to hold its 10-day range high of $728.54. The fact that the technology sector is pushing harder than triple Q suggests that the heavyweights in the technology sector, things like semiconductors and software, are absorbing all the inflows. Triple Q includes communication services and some hardware that is lagging. So the technology sector is the engine and triple Q is the chassis following along. The critical level for triple Q right now is that $728 high. If triple Q breaks that, it validates the technology sector move. If it fails, we see divergence.
And remember, triple Q's composition is why it's lagging the technology sector. Triple Q is weighted heavily towards big tech, but it also carries the baggage of the communication services sector, which is down nearly 1% today. The technology sector is pure play on the efficiency narrative, companies cutting costs and improving margins. That's why the technology sector is winning. The market isn't just buying growth, it's buying profitability in a slowdown. That's why the technology sector is at $188, while the broader market is stuck at $772.99 in the SPY.
Let's talk about that SPY level, $772.49. It's near the top of its 10-day range, which ends at $776.85. Grid, is the S&P 500 at risk of reversing from these highs?
The SPY is testing resistance at the July 12th high of $776.85. Currently, it's holding the $77 support floor. The structure is intact, but it's thin. The SPY is essentially waiting for the technology sector rally to prove it can lift the whole ship. If the technology sector stalls at $188, the SPY will likely drift back down toward that $77.01 support. It's not a reversal yet, but it's a consolidation phase. There's no upward momentum here unless the technology sector extends.
Here is the macro contradiction you're missing, Grid. You're looking at a chart line on SPY, but you're ignoring the yield curve. The 10-year yield is 4.7%. The 2-year is 4.22%. The curve is flat at plus 0.48 basis points. A flat yield curve historically precedes recessionary signals. The market is pricing SPY as if we have normal growth, but the bond market is pricing in a slowdown. That is a massive dislocation. When that yield curve steepens or breaks, it won't matter what your SPY support level is. The revaluation happens overnight.
SPECTER is highlighting the cost of capital risk. At 1.5% GDP growth, companies can't grow their way out of higher borrowing costs. If yields spike, margins compress. That's why the technology sector is rallying. It's the only sector that can generate enough free cash flow to offset the macro drag. The rest of the market, especially the consumer names we discussed, gets squeezed between falling revenue and rising rates. That's why the SPY looks weak, despite being near highs. It's being held up by passive flows into the technology sector components, not organic broad market strength.
So we have the technology sector pulling the index, while the rest of the market, specifically consumer discretionary and materials, is drifting lower. The energy sector is actually showing strength on the week, up 6.49%, despite being flat today at $61.03. Apex, how do we synthesize this fragmentation?
We are seeing a forced allocation strategy. The data shows that beta, the general market correlation, is broken. You cannot buy the market anymore, you have to buy specific themes. The themes emerging are 1. Defensive growth, the technology sector/the healthcare sector, 2. Supply chain resilience, HPQ/Dell, and 3. Speculative momentum, RS/Barksel. Everything else is bleeding. The rotation out of consumer discretionary and communication services confirms that institutions are de-risking. They aren't betting on economic recovery, they are betting on survival and efficiency. The VIX at 15.28 reflects this false sense of security. The real action is in the idiosyncratic moves of individual stocks, not the indices.
And that false security is the biggest risk, because everyone thinks the big picture is fine. They see the green arrows on SPY and the technology sector. They aren't hedging. But the Tapestry and YETI gaps prove that hedges should exist. If you're long the broad market without hedging against sector-specific earnings shocks, you are exposed to silent kills. The silence around the VIX is deafening precisely because the noise is happening in the details.
Agreed, and don't forget the small cap weakness. IWM is at $302.71, barely ticking up. It's failing to break its 10-day high of $303.41. While the technology sector flies, small caps are trapped. This is a classic rich-get-richer dynamic. Liquidity is drying up outside of the megacaps. If liquidity dries up further, the support levels grid mentioned for SPY become irrelevant because there's no bid behind them. We are staring at a liquidity cliff masked by a few giant stocks.
Let's circle back to RS, since it's the standout performer. Grid, you said $500 is now support. What happens if it fails?
If RS fails to hold $500, the next major support level is the opening price of this pre-market surge, roughly $480. That would be a significant retracement, but given the momentum, I expect it to grind sideways rather than crash unless the broader tech sector turns. The volume on the way up was decisive. It wasn't a spike, it was a sustained push.
But check the order book depth. Is HPQ or Dell driving similar volume, or is RS alone? If RS is the only one with deep order book support, it's a lone wolf. Lone wolves get eaten. I need to see if other semiconductor or hardware names are starting to mimic this volume profile. Without confirmation from peers, RS is a standalone bet, which increases its volatility risk exponentially.
Which brings us back to the core takeaway. Today is not about going long the market. It is about identifying where the liquidity is pooling. It's pooling in the technology sector, in HPQ/Dell, and in RS. It is evacuating from consumer discretionary communication services and IWM. The data shows a market that is choosing sides. Your portfolio must choose sides too. Either you are in the efficiency leaders, or you are watching from the sidelines. Trying to catch a falling discretionary stock like TPR or YETI is gambling, not investing.
So, to summarize the pre-market landscape, technology and hardware efficiency are the undisputed leaders, riding a wave of institutional preference for margin protection. Consumer discretionary is undergoing a painful repricing, with even positive earnings unable to stem the tide of macro skepticism. And behind the scenes, a flat yield curve and low VIX are creating a false sense of stability that belies the intense internal fragmentation of the S&P 500. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Equities. Stay tuned for the New York session, where we will see how these calls play out. Until then, trade safe.